so we're just going to get right into the panel so we can get right into the substance. So Matt, can I start with you? Today, as was said, we're going to do two panels. This one, we're going to focus on what we'll call the life cycle of M&A. So we'll start with the building relationship phase. So when a smaller company is engaging with a larger company, which you may have some information about, how can smaller companies interact with corporate development teams and have that be efficient when often the corporate development team may have more employees than the startup in its entirety?
We're not that big, but no, that's a great question. I mean, the challenge we have at Home Depot, frankly, is 430,000 associates. So I always like to dimensionalize that for people, and it's slightly larger than the U.S. Navy. So it tends to be difficult to find the right person at Home Depot to go through. I'd say utilize the corporate development team and let them be your jungle guide, for lack of a better term, and get you to the right place and the right relationship internally. That is their job. That is my job to help out with that. That said, what we try to do is make sure we understand that you, as a startup, are likely the CEO, CFO, Chief Strategy Officer, Head of Partnerships, Relationships as well. And so kind of to manage that relationship and understand those things. And I think we have to be patient, really, from your perspective, be patient with us, and from our perspective, we'll be patient with you as we try to navigate this and get you to the right place.
Great. Phil, maybe we can ask, how is the relationship different if it's a large acquisition, if it's a small bolt-on, if it's just an investment? Is there a difference in how you build that relationship?
Yeah, it's a good question. And we're interesting in some respect because we're pretty active as a venture investor, deploying $150 to $200 million a year in venture investments. And then we're also active as an acquirer, doing a dozen or so acquisitions every year. I think that the one difference I would say, Stephanie, is for larger deals, larger companies, the likelihood that you've got multiple touch points already is much higher. So the corporate development team can help really be the air traffic controller for some of those relationships and try to make sure that the company's getting a 360 view of all the interactions and kind of where the relationship is going. And I think on the smaller side, my advice always to smaller companies is if you think that you could see a path in the future where an acquisition by Cisco is a possibility, it never hurts to start building that relationship early, and the corporate development team is here to help you with that.
So a core part of building a relationship is about culture. So maybe, James, you can talk about how you assess culture. Particularly, you guys have been expanding the types of companies you're looking at from an acquisition perspective. How do you think about assessing culture?
So culture is really important for us at Square, and so we very early on, I think what we try and do is depending on how big the team is, like we'll front load even interviews in the process. So if we're sort of less than 20, we'll just interview everybody. And part of it is like, do they meet the bar? But really part of it is how do they fit into the overall culture? And then the other thing is like making sure that you're taking the leadership, CEO, like chief product officer, the head of engineering, and giving them through diligence, but also like having to spend a lot of time with our team and getting and sort of starting to create that feedback loop of like, are they going to fit in? Are they going to be happy? Are they going to thrive at Square? And are the cultures going to mesh? So, and obviously that's bigger. Bringing in 8 people is a little different than when we bought Weebly. We brought in 300 people, and so there you're really focused on, are you going to have sort of an organ rejection culture issue or not? So.
Maybe building on that, Murphy, can you talk about how you prepare a smaller company for what I'll now call the never-ending interview that sometimes the diligence process feels like for a smaller company?
Yeah, it's, Red Ventures is different, I think, from the others on the stage in that we're privately held, founder-controlled, so the culture and the fit is as important as anything else. And so, oftentimes our processes are as much about that fit with our executive team and their executive team as it is about the product set. So often when we're working with smaller businesses, we tend to have multiple touch points, within our CEO, our biz dev team, and the kind of operational team on each of the assets that we acquire. We have a full, what we call a tiger team. So we prepare them that, listen, here are the steps you're going to have to run through. We've done 25 deals in the last 4 years. Here's what they look like. And so it really gives them a view that, we're not going to waste your time, you're not going to waste ours, and we'll move quickly through the process.
So Matt and Phil, this is for you. You're both at big companies. And for a smaller company, there may be concerns about competitive issues. So how should you think about balancing that, which is you want to make a good impression, you want to share information, but you're afraid of the big company stealing all your secrets?
Yeah, I guess, confidentiality is super important. I think for every person who's a corporate development professional, it's kind of innate in what they do. So the line that I would draw is there is information that you can share with the corporate development team through the deal process that's protected by the NDA that you have in place that in some instances isn't disseminated through the rest of the organization, and that can help you make sure that you're communicating the right pieces of data. I think at the end of the day, from our perspective, sharing more information is always more helpful than holding back data. If you hold back information, we're usually going to figure it out at one point or another, and so leading early with the key information is really important.
Yeah, I mean, it is an interesting dance because at the end of the day, if you're looking to acquire a business, you're hoping as an acquirer there is something truly proprietary, distinguished, different about it, and you have to give us enough of that exposure, that whether it's IP or what have you, for us to understand that. But again, any good corporate development executive, I think, is respectful of not just one deal, but their longer-term reputation as an acquirer, and you're not going to go in and steal source code and terminate a deal. So I think it's appreciate that for the most part, most of the corporate folks have good intentions, and we're just trying to satisfy the things we have to get done to hopefully have a deeper relationship.
So maybe this question I'll have all of you answer, which is about the thesis for a deal. How often is it you build the thesis inside your own company and then you go out and try to find the businesses versus someone is more proactive and comes and introduces you to the business, and that's really how you figure out that it's a good opportunity? Maybe starting.
Yeah, I'm happy to talk about it. I think it's both for us. I mean, we definitely, we own vertical marketplaces in the B2C world, and so we have a thesis around sectors we want to be in and businesses we want to own. One of our core tenets as a company is everything's written in pencil. So, that could change overnight, and it often does pretty quickly. But we will go out aggressively in a sector we like, and we'll meet with every single company. And so one of the pieces of advice I would have is, we pay attention to confidentiality, and we're thoughtful about who we share information with. But you should know, I've been a venture capitalist, I've been a banker. I'm surprised at just the access to every company and every industry that's happy to talk to us and share information. So we're really stacking them up versus each other. So that thesis-driven strategy is something we often do for larger deals, but we are opportunistic. From an M&A perspective, you can only buy what's for sale, and we bought a business in a post-secondary education market earlier this year. That's a sector that would not have been on our top 10 list in 2018.
Yeah, it's a good question, kind of, do you start with the idea or do you start with the target, right? I think our approach is, for Cisco, we really look at building growth for the company. So we're focused on what are the market transitions, what are the technology shifts that we want to try to capture and bring to bear for our customers. And that drives kind of the zip code of areas that we want to explore and care about. Now, what gets interesting is once you go out and you start to have conversations with different companies, the narrative then becomes much more refined. And I think in many instances, what happens is we'll decide that a particular business is a particularly unique capability, or the management team is really kind of unparalleled in a certain way. And so in that sense, the thesis becomes much more, and the business case becomes much more dialed into exactly what we think we can do with this particular capability. And in that regard, it doesn't become an instance of, we've got target A, B, and C, and we'll just go after whichever one gives us the best price. We'll usually really become strong believers or have high conviction in a particular company, and then that will drive, a lot of how we think about building the synergy case, and a lot of how we think about making that business successful from a people standpoint once we bring them in.
So for us, most of our ideas come from our product teams, and so we work with them, sort of understanding their roadmaps, understanding like what they're not going to get to, what the gaps are in the roadmaps, and that drives a lot of our M&A thesis. And then we do go out into the marketplace and try and find things that fit into there. I think to tie it back to your last question, I think the important thing to realize is that thesis is pretty vague at that point, and what we then do is sort of synthesize that, especially when we find a target that works, into like a strategic rationale for an M&A deal. And I think that's where that back and forth on information helps us, the corporate development team, work with the product teams, work with the target to come up with that strategic thesis, and that's where it sort of gets a lot tighter. But I think what I've found is that we have a much higher hit rate of getting deals done when they come from a thesis-driven one. Obviously, we look at lots of opportunistic inbounds, but those are when you're trying, then sometimes you're trying to fit a round peg in a square hole. So.
Yeah, and I'm decidedly jaded, so I'll admit this up front, but we believe strongly in it's strategy before structure. So I tell the team, look, if a banker comes up to us with an idea that we've never heard of, that we're immediately excited by, that fits part of our strategy where we have a known gap, then we failed. And so for us, it really is, I'd say 90+% led by internal research, internal strategy, acknowledgement of gaps in terms of where we want to go. But yeah, of course, there's always going to be a banker who pulls in an idea because it's impossible to canvas everything. But for us, we should be leaning into these things and building, frankly, the relationships with you first, hence the reason a lot of us are here, as opposed to just sitting back and waiting for a banker to call.
So as an investment banker, I feel like that's a challenge.
You told me earlier you were no longer a banker, chief strategy officer.
Chief strategy officer, recovering investment banker. Okay, so why don't we talk about this question of taking a stake versus a full acquisition? Phil, I'm going to start with you because you have situations where you've taken stakes in companies and then done the full acquisition. And how do you balance that on the founder company side? Because when you think about taking a strategic investment, you don't know if it's going to turn into a full acquisition. So how do you think about that?
Yeah, so it's a good question, and I think if we look at our venture portfolio over time, we currently have something like 110 active portfolio companies. We've acquired about 10 to 15% of them. So 80 to 90% of the time, our mindset towards the venture investment is very similar to any other financial investor. The way you have to kind of navigate the scenario where we're investing and then we end up potentially deciding to acquire is really one that we try to be very proactive about, fairly kind of at the intermediate stage of the venture investment. So we always have a thesis around our venture investments too. If the company starts trending in a direction that we see starting to converge with one of our priorities, then we use that to oftentimes start a conversation with the CEO before the company decides to go through a sale process. Because I think we want to, as much as we can, be in a situation where we're not having a large auction process going on. We're kind of having a direct conversation with the CEO about becoming part of Cisco, and we try to be very proactive about that if we think the venture investment is the one that's going to go in that direction.
Okay, so now we're going to talk a little bit about the fun part, getting to a deal. so Murphy, maybe for you, you've now, all of you, unanimously said this thesis-driven M&A rather than opportunistic M&A. So you've decided that you want to do something, you go out and you try to find the targets. How do you balance the fact that you want to buy the company and price? How do you think about those two things when you're just trying to get a deal done in the current environment?
Yeah, a great question in the current environment. I think our thesis is, interest rates are low, they'll continue to stay low, you have to pay prevailing market prices. And of the 24 businesses we've purchased, 23 have not been in a process. So we're preemptive, and we know that when we go to a company, we have to put a price in front of them that assures them that additional price discovery through a process is something that they're willing to forgo. So that's always a big challenge. But as we think of different opportunities that we pursue, in most cases, we're chasing after them aggressively. We're reaching out to the board, we're reaching out to their investors, we're reaching out to the management team and really bear hugging the business such that they're willing to commit to a transaction with us.
Is anyone willing to give some advice to founders on what happens when you get a preemptive offer, but there's potentially other buyers who could buy the business?
Take it.
No one's willing to give away secrets.
Look, I think it's a balance. If you're getting a preemptive offer from an acquirer who, when I look at deals, there's other things than just price, right? There is also speed and certainty of closure. And so if you've got somebody giving you a preemptive offer like yourself who has both speed and certainty of closure along with that, I think you've got to give it, a real hard look. I mean, the worst case scenario probably for you when you do have a great offer, bird in the hand is you go run a 6-month process, you completely distract a small team, and for some reason you've upset the original suitor and you're left with nothing, right? That's the worst case scenario. So I'm not saying you immediately sign anything that's preemptive, but you've got to balance those 3 factors. And if those 3 factors are there in pretty good form, you need to think about that.
I'd even add a 4th factor, which is, if someone is coming to you with a preemptive offer, they've done the work, they have that thesis driven, and you can look and as an entrepreneur, feel like it's a place you can go and thrive. This is a reality. That payday you're gonna earn over time. Because that's how deals are structured these days. And so are you gonna be able to stay and work and thrive there for 2, 3, 4 years? And I think a lot of times that preemptive offer is someone who's really leaned in on what you're doing, and that's actually a really good sign of that happening. And so
well said. Yeah.
So James, maybe building on that to your point on how deals are structured. So there was a comment mentioned about where interest rates are, and we could all guess where we are in the cycle. Is there any element of market timing that you try to do with M&A, or is it really all about the synergy and you figure it out in the structure of the deal?
We're not super focused on. Most of our M&A is private, so I think the market timing piece, the cycles are too slow in that sense. We move fast. We're doing M&A to move faster, so we're not going to wait a year for sort of macro things to change. And so I look at each company as almost its own market, especially on consumer and fintech, where you don't. In SaaS, you have more metrics to operate off of. For us, a lot of times you're looking for clearing price rather than having multiples or something to chase down. So.
Okay, so maybe Phil, I'll go to you, and others can answer this. So you mentioned the point about being public. Is it harder to buy a company that has gone public? And so how should a company think about that? Is if they think the ultimate end game is selling the business, is an IPO a good interim step, or does it just make it harder?
So actually, just to add one comment to your last question about timing, and another way to kind of interpret it, I think, is there are natural breakpoints in the life cycle of a private company as it grows, where I think it makes sense for an entrepreneur or a board to say, okay, do we want to go raise this additional amount of capital, or does it make sense to actually seek an exit now and think about that? So from a timing perspective, those are the things that we see coming up repeatedly, and those are the things that our team tries to be proactive around. The process of acquiring a public company is very different, certainly, than acquiring a private business. We do both. We do a lot more private deals. We do public deals as well. I think, in some respects, public deals have a added simplification around price, because you've got a public currency. You know what the price is. Now we can negotiate the premium, but there's kind of already a number on the table. I think the question usually that we have for companies that are approaching the IPO process is actually one I think that James mentioned earlier, which is, what does the management team want to do? Because every management team doesn't want to be necessarily a public company CEO or a public company management team, especially in this environment and with the volatility sometimes that you have in growth businesses. And so, we find ourselves in situations where we're having conversations with entrepreneurs about whether they want to grow that business as part of Cisco, or whether they want to take that in the public market and deal with that dynamic.
Murphy, I'll start with you, but others should answer as well. We've talked a lot about bigger companies kind of buying smaller businesses, but how do you think about building up M&A capability as a smaller business? When's the right time to have that capability? Who should lead it inside the organization? How do you do that as you're growing the business?
Good question. So, our group is 5 people, so it's probably much smaller than others on the stage, but fairly meaningful. We grew to a scale where we brought in some private equity investors, Iconic, General Atlantic, and Silver Lake, and effectively through the early years, they were our outsourced M&A and business development effort. We reached a certain scale where the transaction sizes are complex. There's intermediaries involved. Our transaction range is probably $100 million to about $2 billion in terms of bite size, and in that range, I think you need to be reasonably well known, such that the deals are coming your way in very small processes. You have to have people willing to answer the phone calls, and investors know you. And so for us, it was, and I joined a year ago, is reaching the scale where we're playing for transactions north of $1 billion.
Okay, let's go on to integration. And James, you mentioned this, so maybe we'll start with you, because you talked about the founder needing to have a view on whether or not they want to stay and what they want their role to be. When do you start thinking about integration? At what point in the process when you're engaged with a company are you already talking about integration?
So I started my career in tech at Google, and at Google we were, like, it was 2 in the box from day one. So it was a deal lead and an integration lead, and so I've taken that because they're pretty good at M&A, and so I've taken that through the rest of my career, and it's the same thing. So unfortunately, I don't have a team that I have of one-to-one coverage, but so my poor integration lead has to be in all the meetings. She's there like from like pre-term sheet, and the reason why is like, one, you're going to model the deal wrong if you don't have integration costs fully thought through, which is and I think that's important both for the buyer and the seller to understand what it's going to cost to integrate the business and run it within your company. But second, it's a lot of work, and like you can't really start early enough in my mind, like to make sure that you're building all the process, because there's 2 pieces of integration. One is sort of we call systems integration, which is like making sure everyone has a badge and a laptop and it works, like which is more complicated than it sounds, and they get paid. And then the other is product integration, which is that. So the first one you need to get done in like 60 days. The second one can take 2 years, and so having that first one as like a system that just happens, and then really being able to spend a lot of time figuring out what that second one looks like, because the product integration is going to be, whether, you asked about price, it's like the price, you don't know whether the price is good or not until you execute that product integration. So
I'd like to violently agree with you. No, I mean, look, the diligence should be the start of integration. There's absolutely elements that we call transition.
We have our integration lead run diligence, which is the other thing. So that diligence isn't just about pricing and finding risks, it's about building the integration processes. Sorry.
No, keep going. I continue to agree with you. And again, the hard part is, from my perspective, is that integration head or integration lead at a company that doesn't do constant M&A is actually one of the hardest people to find in the organization. And so going out and finding somebody, again, ahead of a transaction where people might not be yet completely focused on it, to say, I've got to pull away a rock star person internally that can run something for multiple years, and they have to start now before a deal, we even know if it's going to happen or not. That's difficult to get folks to focus on that.
One thing actually to add here, because I feel like we're like M&A nerds, like we know what all this is, but I think for the entrepreneurs out there, like the reason why there's 2 different people is, I'll speak for myself, but like people that do M&A are very goal oriented, and so like they get to a finish line and they're like, yay, like, and then they don't, and so, but
deal toys,
like exactly, like, and integration folks are just cut from a different cloth. Like they're process oriented. They're usually like, your best people come out of your project management offices, and they do checklists and things like that. And so the reason why, as an entrepreneur, you're dealing with 2 different people is it's just 2 different skill sets. I've yet to find someone that has both skill sets. So we hire like the type of people that get M&A deals done on the deal side, and then the type of people that can run that longer integration process on the other side. So that's why it's not just that we love to have headcount and add all the people. So when you're an entrepreneur and you're seeing like all these people, like that's why. And so.
Yeah, it's a great point. There is a different mindset and a philosophy, right? I sort of think of integration as this key linchpin that is going to be connecting the business with the synergy case that actually drove the reason for doing the deal in some respects. So once the deal closes, there's all of the, and I think as the entrepreneur coming on board, it's easy to see the first half of, I think, what James was describing, which is the badging and the laptops and the getting your benefits set up and all of that. But that integration person also is the person who's trying to create in an operational manner all of that synergy, that economic value that you've tried to hopefully believe you can achieve, that kind of justified the purchase price, but also got the entrepreneur and the business sponsor excited about doing the deal. And so that's actually where, although there's a big process piece of the role, there's also a really strategically important impact as well.
Yeah, and to add on that, and one of the things that we do in each of our transactions that we usually as a reward to junior operators that want to work on kind of the sexy M&A transactions, we give those best performers an opportunity to work on this due diligence team, and in most cases, a handful of those people go and join the new business. So it's a smooth transition. There's an accountability around the synergy case, such that it isn't just finished and everyone moves on.
Phil, can you talk about how you balance synergies with leaving something alone and allowing the company to continue to grow and innovate? How do you balance that in a transaction?
Yeah, so I think we're kind of interested in that through the life cycle of Cisco, we've done a ton of M&A, and there's kind of a pendulum that swings back and forth sometimes, which is in certain phases, we'll buy companies and we'll completely integrate them. And completely integrate them means engineering goes over here, sales goes over there, marketing goes over there. And we still do that a decent amount for companies that represent extensions to businesses that we're already in, or if we're going to integrate something to an existing product. But in many instances, if you think about Cisco as a business and what we're trying to do, becoming more of a software-oriented company and a software business, we're actually acquiring a business because it has a unique motion or capability that we maybe don't have natively. And so in that respect, we're actually intending to leave it alone as long as possible, and then over time see some business value or product linkage. Now, the toughest piece of that is setting the right expectation with the management team and the company that you're buying that says, yeah, you're still part of this bigger business, but you also want to really preserve your own identity and culture and way that you sell or way that you build. And so if I look at an acquisition like AppDynamics that we did, and Jyoti was here yesterday talking about his experience growing that company, that's a business where we've left them very much alone, and we've chosen to actually support a lot of what they do that's very different than how we traditionally run our business. But there's a handful of linkages that the GM who's running that business understands we're building back to our core portfolio. And then the challenge is also making sure that we're funding and resourcing and hitting those engineering and product timelines together.
So maybe last question for everyone. Piece of advice that you have for the entrepreneurs in the audience who are thinking at some point about selling their company, either about the sale process, about buyers, about integration, just your best advice.
Everyone's looking at me. I think I go back to the first thing we talked about, which is the thing you need to remember is we work with our teams, we're coming up with Thesis, but there are even just being here this week reminds me of there are thousands of companies out there. Even that fit a Thesis, there might be 50 or 100 companies. And I have a good team and they do a really good job sort of mapping things out. But at the end of the day, having us know who you are because we've met you, because we've talked to you is really important. And so and that starts even before you're selling yourself. It's just engaging with us, taking an opportunity if you meet someone from my team at a conference, or if we reach out to you and you want to come in for a meeting. I just think it's important, and especially as the tech world expands. I think being here in Atlanta reminds me of Silicon Valley all by itself can be overwhelming for my team when they're looking at fintech, but now there's all these other centers to look at, and so it's just remembering that if you have to be on the map to be on the map, and so engaging with us, especially if you kind of manage it with your time, is the best way to stay on the radar, I think, to do that. So.
Yeah, I think I would say take every touch point you have with an acquirer seriously. I think every single conversation you have with somebody in a team, whether it's a junior member of a corporate development team, whether it's a CEO of Cisco, what have you, every single one of those touch points are important. And every single one of those we're assessing from both sides. Fit, strategy, long-term benefit and value, so take them seriously. And the second piece is understanding the timing has to work from both sides. And so some of the best acquisitions that I've personally been involved in are deals that may have taken, and again, don't cringe, but 3, 4, 5 years. Because of the time that we were interested in buying a company, maybe they weren't ready, and then vice versa. So understand the timing has to work out for both parties.
Yeah, I started earlier talking about everything's written in pencil, and certainly for us, we are thesis driven, but things change pretty quickly. And my recommendation would be, build multiple touch points, have a business champion, work either on a commercial relationship or have some specific relationship with a business champion, and keep in touch with the M&A or corporate development team and work both of those relationships over time. Provide us updates as things change, as you hit different milestones, because through time, if an acquisition isn't right day one, maybe a year or two later, it may make sense.
I'll try to actually throw out 2 points. One is, I think, something to keep in mind is that most people who do corporate development at, growing technology companies are really in a position where they want to be an advocate for innovation at their business. And so they want to kind of be the person who can help you navigate the organization. They want to be kind of the cheerleader for you internally if we're really excited about what you're doing. And so you may perceive that we're kind of the gatekeeper, and we are, but we're also really trying to be your champion internally. So that's kind of maybe one thing. The second thing I would say is, in a deal process, and we didn't get into a lot of the nitty gritty of kind of the T's and C's of a deal process, but I would say think really hard about what you care about. What are the most important terms to really focus on? Because one thing I've seen is if you're going through a process, there's 100 different little knobs you can try to tweak, and some people go through this motion in a way that they're trying to optimize every single little detail of the transaction. And if you're a serial acquirer, you kind of have your playbook, and there are some things that you're going to give on, and there's some things that you aren't. It's really helpful when the CEO says, hey, look, the most important thing for me is A, B, and C. And so, there's a bunch of other stuff that we're going to have to negotiate through, and I want you to be fair, but these are the things that I really care about. I think that helps move the deal along much more rapidly, and a lot of entrepreneurs haven't taken the time to think through that. And so I always encourage people to think about what are the things that they really need in a deal, because we're going to try to work to see if we can make something happen that way.
Great. Well, I think that's a lot of good advice for the audience to think through at their tables over the next 15 minutes or so. So Murphy, Phil, James, and Matt, thank you for being here.